Hi everyone, welcome to another episode of World of Oil Derivatives. I'm the CEO of Onyx Capital, Greg Newman, and I'm joined together with Vincent Wu and Ehsan Massah from the research team at Onyx. To get straight into it then, as normal, we kind of look at the latest headlines or how like the kind of headline oil prices are moving. So Ehsan, do you want to start us off?
Yeah, so in terms of price action for Brent, seems like we're kind of back to the levels that we saw the sharp rally after the OPEC announcement. There was a little bit of sell-off in the second week of June, but now we're back to around like 76, 77 levels. And it seems like that the market is quite happy, to trade these ranges. And this has been going on for a while now, but I guess the story is more in the product side of things, looking at gas oil, looking at the gasoline market, and it seems like money is slowly going out of the crude benchmarks into the products. We saw some short covering in gas oil, and also some addition of length. Seems like people are happy to buy that, and it seems like the strength in gasoline market has kind of like blurred the effect on gas oil, and people are paying less attention to it. But the cracks has been on an upward trend for the last 3 weeks. Seems like around here we might see some profit taking. Technical indicators are telling us that.
In which contract?
Gas oil cracks.
Gas oil cracks, yeah.
Yeah, seems like that we had a good run, and we might see a little bit of profit taking. But then the further down the curve in the deferred, with the economic slowdown, there is less consensus and less betting on getting long in the contracts, etc.
Yeah, it's been a bit of a ride though. So something we focused on this year for the first half is gas oil. So coming in kind of really strong, long positioning, majors trade houses, from what we've heard, were very long, didn't do so well by the end of Q1. Then we kind of had an over positioning short, right? We talked about that on previous podcasts on the research. It kind of started to have like a bearish tracking trade, and there was talks about second half demand, ironically, for gas oil being weaker and all that. So there started to be a bearish kind of consensus, and then we talked about how it's kind of lazy, almost like getting complacently short gas oil when things haven't really sorted themselves out. We've since had nat gas rallies and bits and pieces, but it is still strange. If you're looking for a fundamental story, I don't think there is one, because if someone's going to point to second half demand, well, we were told that gas oil second half demand was going to be weak at the beginning of the year, so you can't just have it both ways, right? I think it's a positioning story. It was stopping out on the way down, then people getting short, and they're getting stopped out on the way up, and it's just as simple as that. I think that's all. I mean, this is what the data suggests, and no one's told. Well, we haven't heard a coherent story either way, because if someone wants to tell me this is a fundamentally bullish reaction to what's going on, the underlying physical of gas oil, China have got like some kind of record exports. It's got floating storage. It's just not a healthy picture in the East, and I don't understand why we're in a bad picture in terms of supply wise locally in Europe either. So to me it's a complete financial move. I mean, but then again, this is the whole point we're having this podcast. Any thoughts to contest that?
I do agree this is very much a financial move based on financial flows, based on market positioning. Towards the end of last year, China ramped up its export oil product export quotas, including for gas oil, which exerted downward pressure on the cracks as there was a lot of gas oil supply, distillate supply was flooded into the market. This helped gas oil cracks correct downwards from record highs this time last year, around 40, 50, even 60, down to around 15 to 20, which is the range we're seeing recently in Q2. So recently, the positioning has been the most bearish it's been for a very, very, very long time. Net positioning is actually skewed to the short side, which is quite rare, because for other products like crude, Brent, WTI, US gasoline, heating oil. It's always on the bullish side, net positioning, meaning there's more bullish positions than bearish positions. But actually in European ICE gas oil, low sulfur gas oil futures, for a couple of weeks, for 2 months, there were more bearish positions than bulls, which meant sentiment was from investors was quite bearish, perhaps due to weak macroeconomic sentiment, recession fears. But at the same time, this means because the market was really rather saturated towards the sell side, it was, as you mentioned, Greg, when the market was almost lazily short, so almost primed for rally, because the short investors who can short are already in it. So what's left? Are they going to defend their positions, or what's more likely is they're in the money, they want to take a bit of profit. It's also great for the bargain hunters, people wanting to enter at these low prices as well. They see this positioning, they're like, okay, there's room for more bulls to enter. So yes, very much a financial story here. The macro is still very much a lot of recession sentiment, but it's more likely than not a correction higher, and we're seeing a higher baseline for now.
I think generally speaking, the market is in this sense of like there's no gripping story either way. There's no collective sentiment. I think it's not a good market for that reason, for in terms of confidence and conviction. So the flat price, for example, it feels like a lot of people have waited on the wings. Bargain hunting, I think we've seen at the low 70s in Brent, maybe gasol as well, and certainly putting eggs into the gasoline crack. That's done quite well so far. But equally, these are not high conviction, going to 150 type trades. They're just kind of flow based trades, relative value based trades, and that seems like that's all that's working right now. And even like the trending channel we're in, from a technical point perspective, Brent has been in this nice channel like 72 to 76, around that, and it's just probably going to stay. But it makes sense because what is the upside story, but equally what is the downside story, because we keep having these threats of recessions. We were promised a recession this year. We're already like getting towards the second half, and it's just not really coming together. So I know that people say, yeah, but the rate's coming, and all eyes on this, all eyes on that. But whatever is thrown at the market, bullish or bearish, it's just not really convincing either way, right?
I think like a great indicator for that, especially you may be talking about like, I don't know, very very high flat price levels towards the end of the year. One great indicator is looking at the option skew and how people are betting for like DEC Brent futures or DEC TI, and it seems like the skew is definitely more towards the lower strike prices. So in a way, if anything, people are betting more for the price to come under pressure rather than having a significant rally. So we've got that, and it's everybody gets the same sort of reports. Everybody gets the same sort of like supply demand numbers, like all the information, especially on the fundamental side of things. You can subscribe to different places and like get the supply and demand numbers. And what really matters is that when you take in all those information, how are you going to go in the market and put on a bet? And it seems like at the moment, the bet probably 2 weeks ago was a lot more towards the downside. It has become less, but the skew is still towards the downside. Not so much 100, 120 for flat price towards the end of the year.
So on that point, so we're saying there's kind of generally speaking a short bias in the market, yet contracts are generally moving up in the last week or so. This is what I'd call like a low liquidity, like low liquidity, low volatility but trending market. So if it's trending north with low liquidity and low vol, it's just kind of drifting up. So if you saw the rally yesterday when it went up to like 76.50 or something like that from low whatever it was, mid 75s, that rally was just low volume, and just it's almost like you couldn't stop it because no one had any flows to pump into the market. Seemingly no one had any conviction, so all you could see was it just step by step slowly drifting up with low volume. It's a weird thing to see because you're like, why is it like that's a dollar move? And if I was short or whatever, had something, I've just lost a bunch of money just because of a nothing, like seemingly a nothing thing. But price action doesn't care about volume or liquidity, right? It just moves where it moves. So that's a bit of a frustrating market, I think, for a lot of people. But at the same time, it does mean that if there is really aggressive flow to come in, it will move markets. So if it's a big producer hedge or conversely a big end user hedge or anything like that, I think that's what the market needs. And this is kind of what I want to talk about today, a wider macro thing. You know, it's. I think I looked at Dylan on Crude Desk was showing me the correlation with S&P 500 and Brent, and it was like for like for a while now, which kind of makes sense, because if there's no real conviction, you just kind of let the financial markets as a whole play out, and that's where you're getting your indicators from, right? That, to me, that makes a lot of sense. And until there's a really strong fundamental argument or story to latch onto, I just don't see. Yeah, I think it's very likely that will continue. But anyway, you know, what is happening in the macro markets? We were promised this recession. It hasn't happened, but there's still talk. So it's the interest rates, again, are coming back as a story. And UK is not usually like a huge theme in the world, but it's probably like the most likely to go into recession. So on Wednesday, tomorrow we've got another rate hike potentially. We've got inflation reports coming out, which could lead to a rate hike. And I think there was a report this morning about actually like the shopping indexes or something like shopping prices are slightly eased or whatever. So we need a new impetus is what I mean on macro markets, because sterling's had a huge rally, like S&P's had a big rally this year. It's not what we were promised, and yet you have guys like Ken Griffin coming out now, you know, quite a few different funds and banks still talking the recession game, and they're starting to put positions on to reflect that. One of them being this like credit-based trade, which hedge funds seem to love, like Bill Ackman's style in COVID, when he bought a bunch of CDSs in hotels. So hotels were going to go to zero, and not go to zero, is in like no one was going to use hotels when lockdown. So he's like, I'm just going to buy CDSs, like credit protection against them, and he did really, really well out of it. I think he literally went on the news using his brand name and said, this is like, he stirred it up massively, like this is going to, hotels are going to zero, you know, everything's screwed, blah 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 blah. I think a week later he took profit on his positions,
generating a herd, and then
he made like a few bill just by doing that. So this is definitely the game, right? You have to use your brand name. So who's got a big enough brand name, who's modern enough that he's still relevant or she's relevant? Like at the end of the day, like someone comes out, like who's that woman last year, she's lost a bunch of money 2022, Kathy Woods.
Right.
So she would have been a huge brand name in 2021, making loads of money. Now you've lost loads of money, no one really cares what she's got to say, whereas Ken Griffin you do. And what was the other one I was saying?
Bill
Ackman, sorry, isn't really
Warren Buffett.
Yeah, Warren Buffett. But and he's got loads of cash reserves. Ken Griffin is talking about credit trades for Citadel. So this is what you're going to do if you're a big hedge fund that's got like billions and billions under management. You've got to move the whole market. You've got to get the market G'd up again. Right. And as you say, Ehsan, like it's skewed to the downsides. They're coming like onto the media being like, oh, I've got a few positions you might want to know about.
That's actually, that's quite interesting that you say that, because I think, so in the headline, the Ken Griffin headline, he was going to Hong Kong for the first time after the COVID-19, the pandemic. And it seems like, I don't know. I don't want to be a conspiracy theorist, but you know, in line with what you're saying, it seems like he's setting the scene. The headline is like, I'm very optimistic, China, and China growth. But I'm not too sure if the numbers are backing it up, or is this more like a show? But
this is what I was going to bring up. Like, you can talk it like conspiracy, but at the end of the day, isn't that what you would do? Yeah. You've got a huge amount of money to deploy. Are you really doing your job if you're not going out there using your brand name as a CEO or chief investment officer and pushing this in the media? It's not like that's illegal. You're just saying, like Bill Ackman was like, hotels are, it's not like he was wrong or like he was saying something weird. It's just he'd done the work to get himself a big brand. Now he's using that brand. So that's just what he's doing, right? In China, in Hong Kong, sorry. Yeah.
And it's interesting that like it seems like bringing it to the media is actually working out quite well. Like if you remember from Big Short, Michael Berry, he just waited on his position for like 2 years, didn't talk to many people, and then like market rumors, started to become kind of widespread, and then everybody started. Maybe at the beginning he could come out and you know, make some noise about it, and like.
Well, it's classic because he's looking at the numbers, saying this is overvalued. It needs to be valued here. But until people care and sell, it won't happen.
Exactly.
So that's almost your job now. You can do your research, but you've got to get the message out there. Otherwise, no one's going to react to it. And you need to be a big enough brand name that people actually care. Yeah. Because some people just reverse indicators. You're like, oh, well, there's that guy on CNBC. You're like, oh, okay, we're getting these names today.
Yes. The guy with the goatee. I don't remember his name.
The money guy.
Yeah.
Mad Money. He is literally a reverse indicator. I think someone put like an ETF together, or like some structure together that was like
Jim Cramer
putting on like the reverse of his trades.
I
mean, but then again, he's still a big name actually, and you still want to know what he's, even if it is a reverse indicator, you still. So
I think back then, like, there was like a lot about the Cathy Woods thing as well. You know, like her ETF was called ARK, and then there was some stuff called SARK. Which is short arc.
No, but I mean, it's very like, it's not like she won't be relevant again. It's just people are fickle like that, right? Like, who do I actually think's got a hold on the market right now? So, oh, they said that before, and that's coming in. Oh, that's interesting. Like, I'm going to keep. Yeah. And then it eventually, you need to use it sparingly and wisely. And again, this goes back to what we're saying about OPEC. Like, if you're gonna go out to the media and talk, it's a bullet that you can't just use all the time, right? You got to use it, and I think more and more people are learning this. But we've seen it with loads of people in oil, actually. If you go back, like Pierre Onderond, he used to do this all the time. Go on CNBC and say, "Oh, the market's going lower," or "The market's going higher." But why wouldn't you do that? Like, it's your job to make money on a position, and obviously you believe in that position. So all you're doing is talking about that position,
advertising your book.
I mean, is that, I don't know. That's not really morally wrong to me. It's part of the game, and people want to know. Obviously, people want direction. The problem is what we've just been talking about at the beginning of this episode, which is if everyone's too herd, the market, and if there's markets moving in too herd of a way, as in there's no real conviction from both sides, it's just following things, then it becomes purely a positioning story. So the reverse has happened of pretty much everything. So everyone's getting G'd up. Well, not everyone. Hedge funds got G'd up about the OPEC cuts. Okay, then it sold off. Does the reverse. Everyone got G'd up about gas oil, it's sold off. Now everyone got short gas oil, it goes bid. And I think we are in that market. It's just a very dangerous market to follow a herd right now. You want to be like relative value trading if you can.
It's very, like, this reminds me of like all the crypto mania, you know. It was basically that, right? Like, you hear
it became that. But I think at the beginning, the early movers were like, you know, they can see the value proposition. They can see a lot of incoming flows. It was a great bull story.
But then there were like too many gurus.
Once everyone was it was just chopping around, and like people would it's so obvious it was propped up, you know, and that's it's very hard to do this. But I think at some point you have to to maintain credibility as like an influencer, or even if you're trying to just control the whole market, you need to also let the other side of the story come in. You need to let things reset, because like crypto's still a bull story, really. But it's just been through all this hype. But if you were, you know, I've always been bullish, I'm a long-term bull, I don't need to get hyped up when it's high, because it's already been, and that's what people were doing. They were trying to, like, people are so greedy. It's like, you've jumped it up to here, you've pushed it up to here, you've hyped it up to here. Now you're going to go again. Now you're going to go again. Now you're going to go. Like, when do you actually stop and like maintain credibility of the original story, which is like, the same with carbon credits, for example. Like, that had a big sell-off last year. Again, hype. It's like, if it's a bull story, you just got to let it play out and come out in the media and talk about it at the right moments, you know, on dips and things like that. And that's my personal opinion. But people are getting better at this. And, you know, we don't know how deep it goes, right? Like, everything is linked to financial markets now. Like, pretty much everything, every war, every commodity price spike, there's always going to be politics behind it, and people trying to influence it behind it, because it's money, right, at the end of the day.
Yeah, for sure. I think it's all about people wanting, the influencers wanting to control the narrative, or pushing their own narrative, their own point of view. There's nothing immoral about that. There's always going to be space for analysts to come out, and they're just doing the analysis on their views of the market. Perhaps it's their personal view, or it's the house view. So it's not only you have the influencers, but also people do listen to whatever the companies, the big banks have to say as well. So it's not just individuals, but you have JP Morgan, Goldman Sachs, and the oil market. The IEA, their demand forecasts or their price targets. When their reports come out, people read them. People listen to what they have to say. Just like whatever the Goldman Sachs forecast is as well. Last week they downgraded the forecast for Brent crude for December 2023. I believe this year to this week they downgraded their forecast for China's economic growth this year as well. So when they have these numbers out, people, news agencies, journalists write about that, and people react to their forecasts.
Yeah, but we've seen so many being have varying degrees of influence over time. Ray Dalio used to be a big one. His general stories and narratives very compelling. He wrote books. I mean, he probably kind of created that in financial markets, that big presence influencing thing, I think, to some extent, or at least the control of it. But then, everyone started copying his model, and he started to get things wrong. And of course, as you'd expect over time, and then it's less of an influence now. Warren Buffett was the same thing. He's so much more long-term than probably anyone else, right? So you can have, you can copy his trades, but he's not looking at the same time frame as you. And I would say he's one of the more, for me anyway, when I listen to his stuff, he's never trying to short-term hype something, and he's always quite transparent. And he's like, there's nothing deep going on here. I'm buying it because it's good value. It might take 10 years. Yeah. And a lot of people don't want that. They want short-term, come on, I want to know now, and I want to make money now. And everyone's got themselves to blame, I think, when it comes to being influenced. Because what are you looking for? If you listen to Warren Buffett, he's only ever talking about his passion for markets and value investing. Even when he bought Activision, that company, the Microsoft's trying to buy them. He's like, I'm telling you why I'm buying it. It's whatever the number is, I can't remember exactly what it is, but I'm buying it 68. The acquisition should go through at 72. That's why I'm buying it. So if the acquisition goes through, I make $4 a share. But if it doesn't, I've got a great company. End of story. If you then go into that trade and you lose loads of money, that's not his fault, right? He was being completely open and honest about it. And he would actually advise you not to make stupid decisions. He advises you to buy indexes and average over time. So if you're not listening to these things and you want the short-term hype, I think it's your fault. And again, I know I've talked about Succession a few times. Fucking great show. But there was one bit where the guy was the dad was like, what do you think we should do with this company?
Spoiler alerts.
Whatever, it's previous episodes. But the boss, Logan Roy, was to his sons, what do you actually think we should do with this company? And then Kendall's content, and we should do with wanky tech stuff. And then Roman, what do you think we should do? The kind of Joker kid. And he's like, well, let's just start up a hedge fund, put on positions, and then just use all our media arms. We've got this massive global conglomerate, and move the markets with our media. And they're like, But if they're saying that, writers in the arts are able to come up with this stuff, come on, everyone must be doing it. This is not a new concept, right? So again, your point about conspiracy, it's not really a conspiracy. We should all know that everyone is trying to influence markets all the time. The good news is that the markets are so big, and so much money is in the financial markets, and all the kind of a lot of the inefficiencies have gone from wider markets, that it's so hard to influence. And then you see people getting frustrated because it's well, I thought if I do that, the market will just keep going higher and higher and higher and higher. It's no one has that amount of control anymore, which is a good thing. So you just got loads of people trying to influence it, and in a way it's democratizes itself, because you've got both sides trying to influence,
Yeah. I mean, bringing this probably back to our market, the oil market, especially with value investing.
What, Succession talks about oil markets?
No.
I'm joking.
But when you were talking about value investing and Warren Buffett, I was actually thinking, is there actually many instruments in our markets that could be used as something that people can just invest in as value investments? Or is this market really influenced by just couple of players just moving the market up and down, and it's kind of very, very difficult to have a long-term investment plan to get involved in the oil market? What do you think?
Long-term? Yeah, no, I think it can never be that long-term because of how much fundamentals and everything changes on a whim, right? So if you thought there was going to be a lot of the 2000s was all about being long Brent, and if you talk to kind of the more legacy oil traders and the hedge fund managers at the time, it was just get long, because there was this big long-term bull story about China demand essentially, and that just was a nice steady trend, and a lot of people made money out of that because it was just a general growth story. But it's chopped and changed so much since. You have things like COVID, you have things like financial crisis. Like, how can you value invest over the long run when you have these things going on? So I think it always has to be medium. But what I will say is, no, I don't think it's just a few people moving markets like Brent futures. It's too big now. There's too many different players, which is great news, I think, because it's, you know, diminishing influence of historical huge players who like kind of monopolize things. But the other thing, like one thing you put in your video, Vincent, in the Wu Fridays, oil swaps is great for that, right? So the more oil swaps are seen as just generally oil futures like Brent, these differentials and all that, there is real physical maths in a sense of like the physical prices, the differentials of these physicals and everything that's going on in the physical market has a real tangible mathematical value. If you eliminate the kind of Brent futures outright prices and you eliminate all the noise, if you trade like a differential like gas oil versus jet, you know, you just got this differential. What is driving those differentials are driven way more by physical. So there's no wonder the kind of trade houses and majors love to trade them in the time spreads, because they have the information on the physical. They can value invest, right? They're like, the Brent spreads right now are 10 cents, you know, a spread down the curve. I can see XYZ happening. I'm already getting inquiries. I know that the physical spread's going to be more like 70 cents physical diff. I know from a a value investing point of view, that's undervalued. So in order to capture that, I might be able to trade one spread against another spread like a fly, and just massively size up, because what you're trying to capture is a very specific type of value. And the mistake is thinking that the oil market is there to always represent physical value. It's so big now and so financialized. It's just representing people's sentiment and flows. However, if you look at the diffs and time spreads, you've got all this real physical link that's almost, I wouldn't say 100%, but like more like 70-80% influenced by the physical price. That's what people should want to trade if they're looking at.
If they have the optionality to actually own.
Well, no, I was more
assets
answering your point about like if you're value investing, like that's just undervalued. Like the Q1 25 regrade in Singapore, jet versus gas oil, is undervalued. There's like real ways that the physical can actually influence that differential, and that's a good value investment. You see what I mean?
Yeah, interesting, because like for example, like I think we had a recent thing in the crude benchmarks, right? Like Brent Dubai, and right, like a huge dislocation due to a headline, and maybe now it's time to get directional, like think about value investing now that there is something that dislocated the prices, and similar stuff that happens like across the product differentials and across the spreads. But don't you think that like you need to have some sort of like insider information almost for doing these value investment, as in like, can everybody just by looking at the curve know what is undervalued and what is overvalued? Is it just the historicals that you look at, or is this you need to actually know how much product is moving where, how much like inventories are looking like across like different regions? What sort of thing is it that you need to be able to do these value investments? But
you're talking about like information that's right now, so the inventories drawing or oil moving across the world, that's happening right now, which the futures market has already traded, right? It's trading at least 2-3 weeks out, more likely 2 months, 3 months, 4 months. And if you're value investing, you're looking at like long-term, year out kind of stuff. So there's no way anyone can know those things. The best you can do is map the day one as best you can and extrapolate out with demand forecasts. But then now you're talking about macro demand forecasts, and no one knows how to predict macro demand forecasts. Otherwise we would know about every recession, and we would know about every, like, it's just never pans out, right? So so I think it gives a great opportunity.
Then you can probably look at like how everybody else is betting.
That's what we do, right?
Exactly.
So do we even need to read the fundamental supply and demand stories and predictions of the future? We just see the positioning itself,
modeling participants' behaviors,
which we know is a guy I know, systematic trading. Like at the end of the day, you know, people who've got these models that are reacting to fundamental information, I find it really interesting, because it's like, the market must move to fundamental information. I'm like, well, hang on a second. Are you just modeling in your system what everyone else looks at? So everyone looks at stocks draw, you buy. So therefore, it makes complete sense that a system would look back at historical data and correlate the two, right?
Yeah.
So that's what I think personally is going. That's what you were basically alluding to, right?
Yeah.
I think it depends on the time horizon, because if you're value investing, or if you're looking at 10 to 30 years, or if you're an upstream producer or investor as well, or shareholder, you'll be looking into, of course, the longer term forecast for oil supply and demand. So that's why the IEA, these reports come in very, very handy, because these investments are not cheap. You want to be looking at a very longer time horizon to see, okay, if it's viable, especially with the climate change debate, ESG, and the energy transition, all of that. So it's important to see where oil might be in 2030, 2040, 2050 and beyond. So that's important. But then for other people, for other traders, the trade houses, they might be looking at more the short to medium term. So of course you do have the fundamental supply and demand, but as I mentioned, the market participants also matter as well. The trader psychology, who's going long, who's going short, all of that really matters in the short term. In Brent futures, it's very much financialized, but in the swaps market, over the counter, still very much trading through voice brokered. It is the market, the price movements can be more volatile, can fluctuate a lot. So it depends on what type of trader you are and what type of person. Are you upstream, or are you a hedge fund? Are you, or just a speculator?
When you talk value investing and like hedging, it's kind of the lines get blurred. You'll like this story, Ehsan. Before you came, Brent Dubai, right? So IMO, the maritime organization, changed the sulfur you could run shipping fuel to max 0.5, right? So there was, well, what's going to happen with this? And I think it's been quite well publicized what happened with fuel oil and gas oil. But another one was Brent Dubai, and I think it was Oxford Institute came out with a study, and a few different people came out with these studies, and they gathered consensus that Brent Dubai would go to like $10. And the reason why was, they were saying, because if you think about what settles Dubai versus what settles Brent, like Al Shaheen, highly sulfurous, it sets the Dubai benchmark, and the differential between Al Shaheen and 40s like is going to be $10. And they did the maths based on where the forward fuel oil cracks were, and said, well, if this much output, and like, it's not like a laughable thing. It was logical.
It's modeled like with logic.
But again, it's just like a huge assumption. Well, so many assumptions there. Anyway, what did we see? We saw loads of people getting long Cal 20 Brent Dubai because they thought it was going to go to 10, right? And they could buying it at 3 or 4, I think it got to. And this wasn't that far out. This was like a year out. That was a value investment trade from the wider market. Anyway, what happened? Yeah, I mean, now it's
I think in the Dow contract last month it turned negative.
Yeah, exactly. And it's like it's been in the exact same range it's always been in. It's not like, that must be very frustrating for people as well, right? Because it's like Warren Buffett style, but I've done the value investment concept. And I think the other thing about those value investment traders in commodity markets as well as equity is they've got the balance sheet to wear all the losses, and then whatever happens with the market, they can wear it all the way to the end, and then eventually it will come back. But with something like Brent Dubai, that never came back. That was just not how the markets. So it's basically wrong. Like, there's no other way to say it.
Yeah.
That it was
you got to exit.
You got to exit, and there was a big washout and all the rest of it. But what I'm trying to say is, your point about value investing, it's like you would pick up an article, be like, oh, this is really niche. IMO 2020 Brent Dubai. And think about that. Imagine if you're not, like, even if you are in the oil market professionally every day, but especially if you're not and you're looking at it, you're going, this is a like really interesting proposition. This could be a massive return. And it was so wrong. Like it's almost so wrong that like the understanding of the mechanism is wrong. So my point is, because I just touching on what you said about, inside information kind of thing, I disagree. Like, I just think there's zero, like, the information's all out there, and people make terrible wrong calls on the actual physical fundamentals all the time.
Right.
Like, it's very convenient to blame financial markets every time something doesn't pan out as you expected with your fundamental story. But what about when the fundamentals are wrong as well? Like the gas oil versus fuel oil trade in IMO as well. That was gas oil should rally and residual fuel oil should go low. All that happened was, trade houses and majors talked that differential up, or talked fuel oil down, and they made a hell of a lot of money, exited, and then when it actually got to 2020, it all collapsed again. And it was like, where was the fundamental story there? Like, I thought we were promised like some huge uptick in gas oil demand. Like, it was just not true. So I don't know what you do about it. What do you say about that? Like, an equity, that's why equity's a bit like, not easier, but come on, it's about cash flows, future cash flow. The only thing you're speculating on is future cash flows, but the actual value of a business, whilst it is kind of subjective, there is profit, loss, revenue, it's all about the growth. Whereas with oil, it's like you're trading mechanisms, and clearly the market really doesn't really have a great handle of it in general, because how do things like that, how can you be so wrong so consistently and then blame the financial markets every single time, or blame whatever you want to blame? But you see what I'm trying to say?
Yeah.
Even if you have this great insider information because you trade physical, how come you get it wrong so often then?
Yeah.
It's a great market for that reason, is what I was trying to say.
Yeah, I guess this is why, like, there's a lot of like new trading companies popping up and like closing down. Is there's winners, there's losers. There's always like moving, and is always that's the thing. It's like a lot more exciting than like sitting on your Walmart stock for like 5 years for it to actually finally give you like a 2% return, or like a good dividend, or whatever. But like it's a much higher pace, and if your P&L is not doing so well, you might need to just shut the whole thing down. And it has happened, like, what was it, like 2 months ago in the North Sea, or if it goes well, you make a lot of money, like all the majors did back in 2022. So
what I was going to say, this really, for me, it's the fallacy that these like oil traders make a lot of money from a spec basis. They might spec in the sense of like run a winner. So if you get a contract that's very cleverly worded and it gives you like great optionality to take the loading of oil at a retrospective price, so all these funky things that go on in contracts, that gives you like a little uptick, right? You're basically, instead of getting long by paying the offer, you're getting long on the bid or slightly below. So you can run that, having
triggers and stuff.
You can like, it's really great stuff. It's their model is like fantastic, and that's the cleverness in the model. So you can't just go and recreate that by sitting behind a screen at a random like hedge fund, right? You have to speculate, you have to lift the offer, and you have to hit the bid, and you have to get your timing completely right. It's the hardest thing to do, and I refuse to believe anyone does that consistently well. Well, the numbers are to show you, but I think that's an important point, because
you mean like in the swaps market, or like generally
oil markets for sure,
right?
But I guess what I'm actually saying, I'm actually advocating for more like retail traders to be in this market as soon as we can, get them access. The average retail trader, or even the wider hedge funds, like who trade loads of different markets, but they only trade Brent and WTI or RBOB gas oils. Like, there's all these 600 plus contracts you can trade, like you say, that can be value invested in if you did them right, like diffs and time spreads. They just need access, and they just need to understand it a bit better, because it's such a level playing field, is what I'm trying to say. Like, you shouldn't be afraid of it, because what you should realize is most traders who are speccing on it, even the most like smartest people who've been doing this the longest time, get it wrong all the time. So it's a great like open market for you to come in and deploy a strategy. It's really untouched market. There's no algorithms, there's no systematic type stuff you get in electronic trading and equities, things like that.
It's not like Citadel always winning on the trades that you do against on these retail platforms.
Well, that's their market
like
making.
Equities. That's what I mean for equities. Like, the retail traders, like, what does it say? Like 80% of the time that you lose money is every time.
Exactly. But I think just to your point, people are put off by the wider oil market because they think there's all this inside information needed, and they know everything. So they don't, though. Clearly they don't. They're showing you they don't. They lose money all the time, and you just wouldn't have losses if that was the case. And if you really understand where the money's being made, it's sustainable, strong business models. It's not speculative guru style trading.
Right.
So it should give confidence to anyone saying, but I think, hang on a second, like, I'm reading all these macro reports, got a really good handle on like whatever it is. And even if it's Indian demand for some reason, like, there's a way to express that in a very specific, clever way that is actually reflecting your view. Not, I'm going to buy Brent because of Indian demand. So I'm going to buy, like some kind of Singapore 95 versus 92 like octane spread,
Yeah.
because I can see where things are going.
Yeah.
And there's only a finite number of traders, but at the end of the day, it trades and settles to actual physical values.
Yeah.
That's a much better reflection of what you're really saying. That should be really exciting for people. So many more options, like you say, as opposed to the Walmart style trade.
Definitely, it is. Yeah, it's a lot more like localized as you get involved in it, and like if you have like some local information, and like it's all about, you know, right, even if you have the right sort of expectation of like where the price should go, expressing that view is very, very important, right? And like you need to have certain benchmark to help you with that. Again, I constantly go back to this example, which is a great example, is like that Brent Dubai again at the beginning of this month. It's a right, this is going to be bullish crude, right? Okay, they're cutting production, it makes sense, but the biggest value that you could have actually like booked was, you know, getting short Brent Dubai rather than the differential, rather than actually like getting long a specific contract.
That was a funny one
like
as
a Brent
well,
futures or like WTI.
It didn't immediately sell off. It rallied as well, and then sold off. But
like,
yeah, I know what you mean.
You're protecting yourself.
Yeah.
Like you've got this big protection because like you basically trading two benchmarks that are highly correlated in terms of the way they.
So you're getting rid of the beta and all the bollocks.
Exactly.
100% agree.
Yeah.
And you can go even granular than that. You got the diff, then you got diffs of diffs, and you can keep going until you feel like you've extrapolated all the noise out.
And flies and this and that. Yeah.
One thing we do have to talk about though is the floating crude storage stuff, because I should have really mentioned it before, but that was a really interesting headline to come out with the whole, you know, OPEC versus US game and production.
Yeah.
So it was a surprise to hear it. I think it was Vortex that released it.
That was on Friday, yes.
Yeah, and it got not like viral in oil market terms, right?
Yeah.
Like everyone started talking about it. So
it was actually Jay Maru. I think you had a podcast with him last year, didn't you?
Yeah, smart guy. But he came out and said that what was it? So
there's 10 VLCCs just sitting like
floating off Egypt.
Yep.
So it's up 40%-ish week on week. So it's a big uptick. So some people are saying it's no big deal. Others are saying that doesn't. How can you have floating storage when you're in the middle of a cut? What is going on? It's just interesting, isn't it?
Yeah. So it seems like, you know, over the last year, again, like referring back to the Vortex's data, over the last year, let me actually put this on the screen for people who are watching this.
Yeah, fun fact from the article, it says the last time Saudi crude floating storage volumes were above current levels was in Q2 2020, when levels hit
the price war.
Yeah, during the price war, but that was during a very strong contango structure.
So that also with floating storage, it means your land storage has to be full, otherwise you wouldn't do it, right? And if it's a signal to market, what it's signaling is that there's a lot of oil around when you're meant to be in a cut. So I don't know, that's pretty bearish, I guess, is the only way to look at it. But market hasn't really reacted that aggressively to it. I think it's just probably when it comes to the next conversation about production cuts and all that, it just adds to the, you know, an analyst's picture of being like, what is actually going on? What do we actually think? Right? I mean, what's there to say?
Yeah, it's definitely something significant. You know, the amount of floating storage around that area is usually around 4 to 5 million barrels. Now, with the two new VLCCs heading that way, it's going to go up to 24 million. So it's like 20 million barrels extra. But the other part is, I think we've got visuals for this, that like in the other regions in the world, the floating storage is actually depleting, like in Asia Pacific, Europe, and West Africa.
Wait, when you see those numbers, Asia Pacific's down, and it's 46.72, and Middle East is only 8 million. It might be up.
Yeah, I don't think that 8 million is correct, because we've got just 24 million barrels.
Okay, fine. But either way you look at it, it's not so much about the floating storage in the world, is it? It's about the fact that it's outside Saudi Arabia.
Exactly.
Yeah.
Exactly. And
who are meant to be cutting, who are meant to have, you know, not enough supply in the markets. Clearly not true, right? Well, at least this suggests it's not true, but...
Yeah, I mean, looking at the benchmarks and how the benchmarks reacted to this, there hasn't been any reaction.
No, agreed.
So
Dubai spreads are
yeah,
actually
exactly.
rallying quite a
Dubai
lot.
spreads are strong, and like people
Yeah.
are buying it. They're happy to get long here.
Mhm.
You know, July, Augie, Sep, Oct, they're all strong.
Mhm.
But that's the thing, is like, has it been that people already kind of know about this and they still decided to buy, or you know,
Or just it's not a huge macro mover of the supply and demand fundamentals, but it is just an interesting anecdote.
yeah,
If you're trying to control the market and you've got floating storage, that's, you know, it's interesting as well. Like you can control the narrative in terms of we are going to cut, we're going to produce this, but isn't, you can control your words. But with the data, companies like Vortex are now, who are all over it, all over the storage and what's being shipped around the world. You can't lie. It's going to come out either way. And that's, I don't know if it was a mistake or not a mistake, but like they didn't factor that in or not. But this is probably more likely, right? Do as I say, not as I do. That's kind of we're kind of reversing that now, right? With all the democratized physical information.
yeah.
But as long as you can afford the subscriptions, of course.
Yeah, I mean, Saudi Arabia directly hasn't really reacted to this, but I guess the body's close to OPEC and Saudi Arabia. They have labeled this as a normal thing.
Yeah.
But
again, historical data
doesn't really look very normal to me.
Is in historically.
Yeah.
How far have you looked back?
So the data is actually over the last year
That you've looked, okay.
Yeah. So, and just doesn't look normal.
Okay.
Yeah.
The other things going on, so we've got the floating storage headline, but anecdotal headline that was interesting. Hurricanes. El Nino.
Yeah, hurricanes, but also something even bigger would be El Nino,
Mhm.
which we have some time left. I'll explain a bit. I think that really also adds to the second half recession narrative too,
Mhm.
because basic explanation, you have these typical weather patterns around the world. El Nino is the southern oscillation is a reversal in weather patterns in the Pacific Ocean. So usually the trade winds which regulates sea surface temperatures, the amount of rainfall, usually the winds blow from east to west, but during an El Nino phase it reverses, it goes from west to east. What does this mean? It means in the Asia Pacific region, so typically Australia, the Philippines, Indonesia, these sort of areas, they're usually wet the monsoon season because of the monsoon season, but now it's become more it'll become more dry. So, and then on the other hand, towards Mexico, the south part of the US, as well as the southern parts of South America, Argentina, Chile, and Peru, it's more wet, so it's more typically you'll see more heavy rainfall. So it's weather patterns are reversing. So that has an adverse effect on commodity production as well as economic growth, because the reduced monsoon in Asia could in fact cotton, corn and soybeans, rice production in West Africa could be hit by drought, affecting cocoa and corn production. On the other hand, in South America, because of the heavier rains, it will affect copper production, which has an impact on all of the production of electric vehicles and all that sort of stuff. So it affects the economy heavily, and at the same time, because it's a supply side disruption, this means that it will have a adverse impact. It will apply inflationary pressures, which in the context of high interest rates, high recession, it's definitely worsens the economic outlook. But at the same time, with hotter weather in some areas, this means it's gonna put pressure on power grids in places such as China and the US, as well as in Asia as well. So not so much an effect on oil and gas, not so much on hurricanes, because actually it reduces the incidence of hurricanes, so less hurricanes going through the Gulf Coast affecting oil and gas production. But for other commodities such as metals, agriculture, and as well as the energy markets, there's going to be much more of an impact. So really adds to this recession narrative.
But if there is less like agricultural activity, that's kind of surely less demand for middle distillates, right? As in, like, if they get hit by this, there's going to be like a cut down in terms of like producing all the agricultural commodities that you mentioned. Gas oil, diesel is heavily used in agriculture, and like this is kind of affecting the demand for the product, and we have to look at this historically, I guess. What has happened in like really, really dry seasons, like with droughts and.
It's like, 2014, 2016 coincided with a major drop in oil prices, but like, come on, like that's there's so much going on there during that time. I think it's
in
hard.
What year?
2014 to 2016.
Right. Okay.
So that's not really.
Yeah. That was the time that like Brent sold off quite aggressively.
Yeah. So it's just, I mean, it's anecdotal again, but it's hurricane season and El Nino is always like a really interesting time for gasoline cracks. Gasoline cracks have had their rally. Does it? How does this come into play? Nothing much, right? But at the end of the day, your point about recession narratives, it's like another thing. It's whenever you get, I was going to add like a little bit of a tangent, but with the gasol rally, gasoline crack rally recently, last month, you're going to have this lag with inflation on you because it needs to be delivered to the retail arms, which is going to take a few weeks. They're going to get the higher prices, which is then going to hurt inflation or raise inflation, and then that's going to feed into the data maybe a month after that. So the reports that are going to come out now, I guess it's all about trying to get hold of this like momentum in the market, bullish or bearish. But I think it's going to take some time to filter in. I don't know where this comes into it as well, but it's likely to be lagged as well, right? This is kind of like an underlying macro structural kind of conversation.
Actually.
Yeah, it's something that's more that's actually has started earlier this month, but it's going to be extending into next year as well. So it's more of a long term outlook. Yeah. Especially because
you're calling bearish.
Sure, bearish. Yeah, bearish.
Okay, so I think we'll end it there. Again, thanks guys for coming on. Thanks for listeners out there. And we'll have a slightly different podcast next week, but I'll leave that mysterious. And thanks for listening or watching on YouTube, and see you next week.